Belpointe Asset Management. David, it's great to see you. Thanks very much for joining us.
Thanks for having me.
It does feel like a fundamental change, doesn't it? For quite a few years, just investing in the US was the way to go, but US equities underperforming significantly right now.
It's not just about tariffs. And to Mohammed's comments here, the administration is attempting a major shift in the U.S. economy, and they're looking to move from a government-run economy with a lot of spending, a lot of debt, to one and move that capital back to the private sector. DOGE is, of course, part of that. But when you look at that, one man's waste and fraud is another source of income. So that changeover is going to cause an economic contraction, and that's what markets are pricing in.
I mean, in fairness to Trump, he admits that there could well be economic pain. Usually politicians are so Pollyannish about these things.
Yeah, we saw him speak over the weekend on network news. But I think the message really came out loud and clear from Scott Bessent last week, who was making the rounds. And it was very clear that their focus is not on the U.S. stock market. It's on the bond market. That's going to be the barometer of their success in their minds. They want to reduce taxes and they want to reduce the deficit, both at the same time. That's a mammoth undertaking. And if they can manage to pull that off, you know, somewhere down the road, it's going to pay dividends. But there's certainly a lot of pain in the meantime.
It is a massive. I mean, talk about turning a super tanker. The U.S. economy vast. America, of course, itself a continent with more than 300 million people. What is your broad strategy right now for investing?
It's pretty tough right now. You know, everybody's piled into these very defensive names, and if you made that shift over a couple of weeks ago, that paid dividends for you. But chasing some of these names up here right now are probably problematic. You know, bull markets are not led by Colgate, Coca-Cola, and Verizon. That's not a bull market. You know, we're retrenching right now. I would say the ultimate downside, if I had to take a haircut to it, probably take 10% off the earnings number. That brings it down to about 243. Put a 19 multiple on that, 19 times, you're probably somewhere under 5,000. I think that's the ultimate downside, and I think that's where value investors would start to step in.
Give us that number again, sorry, for the S&P 500, and we'll put up...
For the S&P 500, be something under 5,000. What you're doing is you're taking a 10% haircut to the current earnings estimate. That gives you $243 in S&P earnings. Put 19 times that, and that could give you a target as to how much downside we might get.
That's interesting. So for you, 5,000, sub 5,000 for the S&P 500, not implausible. Are you seeing bargains, though, in this market among individual stocks?
There are things to do, and frankly, some of the things to do are overseas. I think what's notable is what I'm seeing over in Europe, and in particular what I saw in Germany. The administration is forcing Europe to step up. And by doing so, Germany's announced a $500 billion euro infrastructure and defense fund. If you put that into U.S. dollars, the equivalent, that would be like the United States putting together an infrastructure fund of $3 trillion. If Trump announced a $3 trillion infrastructure fund, the market would go up, and you saw that happen in Germany.
What about bonds? Would you retreat to those right now? Maybe we'll pop up the old 10-year bond yield.
You know what I would say right now is that diversification matters, and it hasn't mattered for more than a decade. Frankly, if you were diversified, it hurt you over the last decade because nothing can keep up with the S&P 500. That's not the case anymore. A well-diversified portfolio is holding up just fine right now. As a matter of fact, a lot of balanced portfolios with a little bit of international are probably up year to date with the market down.
I mean, they're fascinating times. Do you think some of this tariff stuff is just rhetoric, as the optimists hope, and that Mr. Trump will hold back from a massive, damaging trade war?
You know what? We've been in a trade war for 20 years. It's just the United States hasn't been playing the game. It's mutually assured destruction. Tariffs are ultimately bad. My hope is somewhere down the road, all the countries wake up and say, you know what, this tariff thing, it isn't working. Why don't we start dropping it? Everybody dropped their tariffs. And that's kind of the game that's being played right now. It's a chicken chicken, who's going to play chicken, who's going to blink first. But it's a global game. It's a global chess match. And we're going to see who blinks on this.
It's interesting. You started off by referring to defensive stocks such as Colgate-Palmolive, and investors might be inclined to move into those, or healthcare. Healthcare struggled last year. It's been doing okay this year. But you say a rally in those stocks doesn't constitute a bull market.
It doesn't constitute a bull market. Healthcare, maybe I can make a different case for. If you take last year's sector performance chart, turn it upside down, you have what this year is. Last year, healthcare was close to dead last. Today, it's a leader. Tech was on top last year, and of course today it's in the toilet. So it's a very, very defensive tape. So it doesn't look like a bull market in any sense of the word right now. So investors are gravitating to things like dividends, something with income. That's in response to bond yields that have really collapsed here in the last number of weeks. All very recessionary. I don't think the administration is going to step in to try to save this, and I doubt there's very little that Jay Powell can do because he's still stuck with, I wouldn't call it, rampant inflation, but it's stuck in a certain range. It's certainly not meeting the 2% target that he needs to see.
David, thank you very much indeed.
Thanks for having me.
David Nelson, Chief Strategist at